My name is Stephanie Smith. I have about 27 years of experience in multifamily and mixed-use industry. I started my career back in the day in North America with a focus on operations, asset management, and training. I was managing portfolios on behalf of both institutional and private investors before moving to Europe about 10 years ago. And that was really as the build-to-rent market was emerging. So very exciting time to move over. I recently joined Hubble, which is an end-to-end advisory partner, as head of living sector. We're providing consultancy across build-to-rent, single-family, service departments, and student communities. And prior to joining Hubble, I was director of residential operations at Invesco Real Estate, where I was responsible for the delivery, performance, and operations for about $2.5 billion in assets across Europe. Today I'm joined by the lovely Catherine Rose and John Gittins, which I'll allow them to introduce themselves. Go ahead.
Hi everybody, I am Catherine Rose, as Steph says. I am Managing Director and Co-founder of Verve Life. We are a third-party operator working across the co-living, single-family and build-to-rent multifamily asset classes. I've been involved in build-to-rent probably for the last 8 or 9 years, but under Verve Life for about 2.5 years. We're managing over 3,500 assets, so have got experience with net operating income across of those schemes. We get involved with our clients at super early stages, so NOI budgets from a feasibility, viability point of view, looking at designs, layout, maximising the rents, minimising the NOI, helping clients get design and planning all straight, and then all the way through to the lease-up mobilisations and then the steady property management. And we're third-party owner-operators, we don't manage our own assets.
And John?
My name's John Gittins, so I work for RealPage, represented here by the branded socks.
Feel free to get them if anybody has cold feet, they're amazing.
And I work on a product called YieldStar, which is a build-to-rent revenue management system. So proven over 20 years, running on 4.2 million units internationally. And it's really taking those, managing the revenue effectively and making sure you're optimizing your performance on your rental. And then prior to working for RealPage, I worked for Knight Frank in their build-to-rent team, so advising different clients across London on everything from initial design to mobilisation and asset strategy. A bit about me.
So despite having two less panelists today, I can honestly say we have over half a century of experience on this panel, so I imagine we'll have quite a lively conversation in our 35 minutes. So first and foremost, this panel is really about having a very open conversation about the mythical 25%, the gross to net that it's the unicorn that we all try to reach for, as well as how we can kind of try to flip that on its head and really think about a practical way to approach via data, technology, and a few other aspects. So I'd love to have a chat with Catherine. You do a lot of work, especially around underwriting and taking a look at it. In taking a look at how we can reach these operational efficiencies. The 25% really was kind of an arbitrary number that was found based on a few people's opinion on commercial mixed with a bit with PRS. What have you been finding as you've been kind of inheriting this 25% gross to net from your investors?
So the 25% is an elephant in the room, and actually it's 25% for build-to-rent, it's turning into 30% for co-living, and I don't know where that's come from, and it's 19% for single-family housing, and I don't know where that's come from. But I'm quite often asked that those are the target numbers I need to get for my investor clients when I'm looking at viability and feasibility. But there are so many determining factors in that. So are you including a sinking fund? Am I including insurance? Am I including the staff costs? Am I including VAT? Am I looking at minimising costs in year one because we've got warranties in place? Is it stabilised? How long a budget do you want? And then comparing it to the student market, we've got some clients, and one of our main shareholders is Homes for Students, and they manage 45,000 student beds in the UK. So actually we've got really good insights as to what PBSA blocks manage, which means that learning can be applied to our co-live and our BTR. And I've got some clients and they're working between both of us, and my operational budget is coming out at 25, 27, and Homes for Students might be coming out at 22. Well, I've got churn, so I've got my lease renewals, I've got my bigger events budget. I want my residents to stay longer. So again, what's your strategy? Are you trying to maximise those rents? Are you trying to run it on a shoestring? I think trying to work to 25%, You need to be super realistic. What else is happening in the market? Who are you competing with? I could go on and on and on. The pressures to hit this 25% is astronomical, and staff salaries are increasing, utilities costs are increasing. Yeah, I'll stop.
Well, and realistically, 10 years in, we've already seen that actually that 25% is really, I mean, I've had properties that have run at 23%. Because of the type of property that they are. I've also had properties that have run at 36%, and it is what it is because we had, we had the ground rent, we had greater estate charges, it was a high-end property, so there was a lot more put in around services, and even just if you think about running the amenity space, the utilities within. I mean, if we think about this, and I'm gonna tap into my American nature here for a moment, despite having been here for 10 years. But taking a look at it, 25% was never even the number in the U.S. If we look at some of the models over there, very often people are advised to shoot for 40 to 50% in the underwrite and then try to pair that in where they can. So what we started doing within the industry, within some of the groups, was really starting to dive into cost per unit basis instead. And there are a lot of different factors in this. As you said, you need to think about the structure of the deal. You need to think about how early, you're starting to implement, obviously, your mobilization budgets, all of that. But also, within that, which I can tap into that in a moment as well, but within that, we also created some standardized benchmarking categories, if you will. So we could really start to understand a little bit more about, and for instance, I've got a little list here, but, obviously personnel, insurance, taxes, utilities, management fees, admin, marketing, contract services, and repairs and maintenance. And really, if you think about it, regardless what your own personal chart of accounts might be, these are all the categories that we're looking at. And then, as you said, that's when you then look at the service charge. Well, in the States, we don't really do service charge. We do just CapEx plans, more or less. But, then there's a lot more kind of breaking down within. But I imagine also, as you said, when you're looking at co-living versus your single family versus your build to rent, and even regionally, you're probably seeing quite a variance on that.
Seeing a huge variance. So in co-live, it depends whether it's got hotel use consent, and we're having to adhere to that. So it's linen, room cleans versus a sui gen class. Single family housing, absolutely. And I think there's a debate about what people are lumping into that mobilisation early stage budget. So selective licensing, for instance, they've just introduced it in Birmingham. I think it's £750 per unit. Are people putting that into the front budget, or are they then spreading it out over the 5 years that cost covers? So I think there's so many ways you can cut and dice, and it's where clients are wanting to load that. And I think we're not an owner-operator, as I said, but where you've got an owner-operator and you've got scale and you've got those centralised services, again, how are you looking to recharge that? And that's something that we're really working through in our operational budgets at the moment.
And John, I mean, with the economic headwinds that we're seeing, and obviously we've all been experiencing some very interesting volatility over the past few years, starting with COVID, moving on from that too, and the recovery periods. Obviously that's demanding tighter operating rigor, and off of the back of that, what are you seeing as far as teams optimizing rents and really trying to approach in a very proactive manner from the beginning on pricing?
Yeah, I think the key thing, obviously, the clients that we deal with who are looking at having a revenue management system to help guide that process. There's a step before that I've seen some clients coming in now, which is what they call in the US amenity pricing, which is building out a pricing model quite differently to how we traditionally see it in the UK. So previous, when I was working at Knight Frank, you would look at a development, you'd price up those units based on the square footage, you would attribute some additional value if it was a better apartment with a better view. Where amenity pricing comes in, it means that you can have the pricing conversation happening a lot more efficiently and effectively, because you're building out those premiums. So for example, you would have your base rent for your one-bedroom apartments, and then you might have a value for one if it's got a balcony. You might have an additional value for one that's a higher square footage. And all these additional amenities, I like to call them attributes really, because I think amenities kind of confuses the conversation, but you look at each individual apartment, has its base rent, and then those attribute values on top. And what we found is with clients that are moving towards having a revenue management system, that first step for them of doing the amenity-based pricing has made repricing a development so much more effective and efficient, because instead of going through a spreadsheet of ERVs, looking at each individual unit with your leasing team, with the asset managers, you can effectively move the base rent and it will have a ripple effect on each of those individual apartments. And I think, you know, there's enough to consider when you're running an asset with costs and everything else, with, you know, with getting the leases in. But pricing, I think having a formula like that is a really good discipline to start with. Obviously, I would say that revenue management is the next step, but actually being able to reprice efficiently, effectively, and really understand, you know, the premium that we're associating to one with a balcony.
Yeah.
Is it achieving that, or does that need tweaking? And it just means it takes a bit of work to do to start with, but I'm always of the view now, having seen that, do it once and do it well, and then you're just more effective.
And I think that's so important at the really early stage, so just not talking about operational assets, but where we're asked to do budgets for somebody to think, can they get planning, do they even want to purchase a scheme? We could go in with a base rent of X for a one bed, but actually it takes so much time to unit by unit price, look at aspects, but that can be a deal breaking for our clients, because actually it moves that dial from it being totally unviable to actually, wow, with that uplift, if you can get that for that 3 bed, because it's got a really big terrace versus the 3 bed on the ground floor. So I totally agree, John.
And speaking from experience, because I've been a long time user of different rent optimization tools, but you know, one of the benefits that I always saw was that I could also see the trends on how well certain types of attributes within the units would help to promote those. So, you know, if I noticed that all of my properties or all my apartments on the east side that had bigger balconies, and you know, even for instance, if I had penthouse apartments where I might have put in, say, a cooker tap with a nice wine refrigerator and whatnot, I could actually track and see. Are those more popular? Because that then, from an investment perspective and development, allows me to also think about what else I'll put in. And like you said, it could be that actually if they're flying out the door, it's much easier to go back in and say, okay, well, rather than going in and adjusting every single unit and trying to differentiate and not really knowing what attributes are assigned against it, we can just make that quick adjustment. So, and do that by floor plan, because very often you see one floor plan with specific attributes that are moving quicker. And on the other side of that, the time efficiency for the site teams to be able to just say, well, actually, we know that the base rent for this floor plan is now, 20 pounds higher, or whatever the case may be. The other aspect I really want to talk to you guys about is the concept of void controls. Because really, if we have apartments sitting vacant for, say, 4 weeks, 6 weeks, how does that take an impact on the pricing as well? Because obviously, void, utilities, all of the pieces that go along with that, whether it's the marketing, and, well, council tax, always a favorite thing to have a chat about. But, really, give me your opinion on that.
So I think it needs to be thought about in terms of lease up to stabilisation, and then looking at those void costs from stabilisation onwards, because actually, do you want to try and increase the rent? What's the rental market saying versus that tenant then deciding to move, the cost of them moving, then the cost of having the void costs? It's those turnover costs, as you said. So it's the repairs, maintenance, it's the voids, it's the marketing, it's the time the on-site taker have got to do to the viewing. So we spend quite a lot of time analysing those costs and trying to clearly mitigate them as much as we can for our clients.
Yeah, I think it's one of those things, isn't it, where you want a forward look of what does that void look like at that point in time when you're agreeing a tenancy. Okay, fine, it's going to come up. That one bedroom will come back onto the market in November, and at the moment we've got so many others scheduled to come void in November, and it's having that intelligence and that data to look at what is that void going to cost us, where are we overexposed, where's the demand in the market. And I think that's something to do manually. Is it takes a lot of sort of data points to look at that.
I think that void bit, as you just said, and staggering those from an operational perspective, if you've got the data from the systems that you've got, you can then flex your lease length. So actually, if you know you've got an awful lot coming up in November, tricky time of year on its own, but actually when you're reletting, then you could do 6, 12, 9, what tenancy lengths are you going to then put in place to mitigate that cost in the future? And I think it's that long-term view that you've got to put into place. And it's the same when you're leasing. You don't want to have 25 moves in on the first weekend all at 12 months, because they're all going to renew at the same time, and they might not all renew, they might all vacate. So
Well, and that's exactly the point too. Like, I know with the renewals portion, understanding what that exposure looked like by the floor plan type, and also potentially it could be that you had a specific part of the building that was all coming exposed at the same time, because lease ups tend to happen in that pattern. So therefore the renewals afterwards would as well. And kind of allowing you to have some insight on, well, should I be quite assertive? Because they're quite a bit under. Our loss to lease is really high on this unit, which we'll talk about loss to lease in just a moment. But, you know, or actually, I don't have anything else like this, and I know it's going to be in high demand. I know it's going to fly off the shelf. Maybe I will be a little bit more assertive, and you know, because obviously you want to weigh that out with your supply and demand. But speaking of loss to lease, this is always one of those questions. I find it's very divisive. People either love loss to lease, gain to lease. Hopefully it's gain to lease. You know, and essentially for those in the room who might not be as familiar with it, it's really like, you know, you might say this apartment is valued at $1,500 a month, but you know that you have it let at $1,200, so you have a loss of $300 to that lease. Whereas if somebody coming in is renting it, it's at the higher rate. So are you starting to see more of a trend in your portfolios and with your investors that they really are trying to understand as well what that loss to lease looks like, so they can project what the gap is essentially between market rent and existing?
Less so, but only because of how established Verve Life is. So only 2.5 years of management, and some of the co-living schemes we've only been managing for a year. But the hotel style class we are pushing on our multifamily, we're definitely seeing that kick in a lot more now. Actually, is how are we maximising that loss to lease? Yeah, it's turning into a thing, I suppose.
I think the more assets are trading, that's going to become more important. And I think the American influence with those funds coming into the market, it is an expectation of what they want to see, because they want a true reflection of the NOI of that asset. And you know, you could be in a situation where the rent roll's saying X, but you've got 1 month's rent free and all sorts of different things that are going on, which actually when you look at the due diligence in terms of a purchase, is that going to come up and how's the rent paid? So I think the loss to lease, gain to lease is just a really good measure of getting a clear indication of how is that asset performing, and that familiarity. And I think, again, with amenity pricing and these models that are coming in that have been tried and tested in multifamily, as they start to come through to the UK and hopefully sort of more widely spread, I think it will mean that everyone is on that, has that familiar understanding, and I think it's beneficial for everyone.
Yeah, and speaking of, essentially it's data. You know, I mean, it really comes down to the data, and we very often talk about, you know, benchmarking. Obviously, we heard Sogol speaking about it earlier, which I encourage everybody in the room to please participate in this, because one of the things that we should hopefully, I'm going to jump to one of our action points ahead of time, but really start to think about how we benchmark on a consistent basis, and really think about, you know, kind of a centralized model versus, you know, where it is all mostly pushed out to the site teams for expenses and for operations. You know, actually starting to look at those and figure out realistically, you know, what is the true cost? Because even if something's centralized, you're still allocating salary, you're still allocating hours and manpower to that. And how do we start to see that? So, or even, you know, are you looking at it with maybe additional expenses? Some companies have overages for, you know, kind of additional riders on an insurance policy or something to that effect, which, you know, often go kind of below the line, and starting to have those conversations about where that should sit, and what those categories should look like. So I know I obviously listed a few of those off, but even on income side, thinking about, you know, gross potential rent, potentially the loss to lease, gain to lease, hopefully we get that incorporated, you know, tracking our concessions instead of tacking those on, even short-term fee, you know, short-term rent. Because if somebody is taking a unit for 3 months, they might have a premium. Is that falsely inflating the rent or potentially the value of that unit? You know, and then you answer questions about, well, why is that one so much higher? And hopefully you have someone around who remembers.
And I think we've spoken about grading and whether the UK needs to start looking at grading assets. And I think as John briefly touched on, as assets start to trade, there hasn't been that much trade in the BTR sector. I think there'll be much more transparency about the true figure of these gross to nets. And I think it goes back to Sogal's point about data and sharing this data, because we can't all sit on panels and say, or sit to our investors and say, yeah, it's got to hit 25%. We need to move away from that.
Yeah, because it can't be 25% at all costs, because that can minimize the value, and also that can then have an impact on your employee retention if you're not able to. I mean, we heard in the conversation about employee engagement and retention earlier about how salaries really have inflated over the past few years because of the skill set, because of the demand, the cannibalization within the industry. Let's be honest, it's there. You know, and also, like, if you're trying to cut costs in other areas, that can have a direct impact on the quality of your asset.
I think it really depends, again, on strategy. So as for our clients, are they holding it for 3 years, 5 years, 10 years, or actually do they want to flip it, stabilise? Do they want to invest on that on-site team? Do they want that training budget to be covered by the site? You know, we had Joe speak earlier about the lack of people who are trained in the industry. So whose responsibility is it to cover that cost? And where does that sit? It's things like that in the NOI budget. It's the debate I have with my clients is, you know, if we're in this for a partnership, what is your strategy? If you're holding it for 10 years and you want to retain your staff, you need to cover the the training costs are important, and it is that educational piece, I think, as well as, you know, looking at the tech platforms as well, and the cost of where they split. Does that sit with the asset? Does it split with the operator? And
I think you're right, and you know, looking at the staff training and retention, and this is going to sound a little bit biased towards having a revenue management system, whichever revenue management system you want to go for, but to expect an asset manager, leasing team, renewals team to be fully aligned on that revenue generation and revenue optimization is really, really challenging. And as you say, the more burden that you put on staff members without having the tools to do that becomes more and more challenging, because if they are incentivized to push for a different rent or a different tenancy term or have an expiration at a certain phase, trying to manage that manually is quite challenging. And I think there's enough for all the teams when you're managing an asset to be considering. And if you haven't got the tools to do so, like you say, you're adding to that burden. So I think it's it's interesting, you know.
Well, and in the US, for instance, we saw a trend actually where, as we were looking at the cost per unit basis, which I think is actually quite an interesting model, but what we really took into account as well, and I would love to see something to this effect here, and hopefully we can make this an action point as well, but is really starting to look at kind of grading the properties, if you will. And I don't mean this in a derogatory or uplifting way. I just mean very simply, we have different types of assets. We have some that are boutique style, no amenity, really light staff, you know, and it doesn't need it, but it's a great quality product. We also have other ivory towers in the sky, and naturally their OpEx is going to be quite a bit more. But in the States, for instance, we actually found that where on some of the luxury properties, yes, you still needed your concierge and whatnot because that was expected, but actually you could streamline in other areas around technology. Whereas on, say, an affordable product, because of all the additional compliance paperwork and the heavy lifting, and there's a whole lot of heavy lifting that goes with it, they did need additional staff. So you saw that there was kind of this swap of expense going on between the two. You know, but then also within that, we've, you know, looking at garden style, the single family homes, could be that you're looking at the towers, it could be that you're looking at mid-rise. And having those different classifications really helped a lot with being able to drill in on the benchmarking and the economic outlook programs that we had, which obviously is a huge initiative for the UKA right now. I mean, do you think that the market is mature enough now to start looking at that, considering that we have the kind of, you know, really good quality, but a little bit more mid-market home versus the ivory towers?
Yeah, I think we need to start doing more benchmarking, more grading, and more data sharing, absolutely. We are beginning to see enough scale in not just London, but in the regional cities, from build to rent. We're seeing a ripple effect with co-live, and I think single family is only going to go from strength to strength. And if we don't start now, you know, we'll be trying to turn a tank around to capture this data. We need to start doing it today.
I agree with you.
Very good. I'm conscious of time. I did do a little sneaky check there. It probably wasn't all that sneaky, but you know, would like to think about action points. I think personally, I was already very opinionated and gave a couple of mine. Do you guys have some additional ideas? How we kind of flip this on its head and start to move more towards that cost per unit approach? And
yeah, I think we're definitely seeing more cost per unit in our co-live more than we are in anything else. But I'm seeing that from some of the agencies, so the likes of Colliers, Knight Frank, Everson Young, and when they speak to me and I'm helping them underwrite, they're like, what is the cost per unit, not the percentage? So I do think a swing there is important. I know this is probably never going to happen, but I think a standardised budget template that all operators have to work towards would be amazing. But we've spoken about the challenges with GL codes and the ways different accounting systems work, so that's impossible. But I do think as units trade, we will start to see much more transparency. And I think sharing the data for me.
And I do think that that's where if we can come up with those kind of common roll-up accounts, maybe that's a really great place to start, because all of us are looking at kind of those same, and whether you're an operator or an investor, you're both kind of looking at that, and maybe we can, demystify this 25% and kind of toss it away and go, let's be a little bit more practical here.
Yes, please.
And what do you think, John?
I think transparency of data is key, and even within the individual asset, I think, touching upon the loss to lease, gain to lease, I think that is a really good measure for us to be able to accurately look at NOI. I think if everyone looks into having that as part of the way they run the asset, it's going to be helpful for everyone, So yeah, I think that would be a great starting point.
And obviously technology is going to play a huge part in it, because actually the more we all link up and are leveraging our technology partners and saying this is what we need out of the reporting systems and the capabilities, the better aligned we'll be, the better the underwrites will be when we inherit them.
Yeah.
and also hopefully there's also a bit more linking up very early on between the operations teams and the initial underwrite teams too. Yeah. So I think we are out of time. I think I saw a little bit of a tap dance happening over there. We might have a quick couple seconds if anybody has any questions or any comments. Oh.
Silence.
Very quiet room. Well, I think everybody's going to have a bit of time to go and get a coffee then.